In this video, we'll talk about the best way to trade harmonic patterns, which is to not trade them at all. We will test these strategies over 20 years of historical data on 28 major pairs and compare our results to the results expected from selling essential oils. But what is a harmonic pattern other than the fastest way to the breadline? Well, simply put, it is a price pattern that forms between successive highs and lows. By picking 5 swing highs and lows, we can form a pattern with points commonly called X, A, B, C, and D. A pattern is said to be harmonic if the ratios between some of its legs conform to certain ratios. For instance, 61.8%, the golden ratio. These ratios are derived from the ratios of the numbers in the Fibonacci sequence, something coined by Mr. Fibonacci, a doTERRA wellness advocate. Let's get into the reasons why harmonic patterns don't work. First, they are often promoted without rigor. 2, they are subject to subjectivity. And 3, they are not supported by backtest. Stick around to the end of the video. I'll be showing you a strategy backtest for common harmonic patterns on 28 pairs from 2004 to 2003. Harmonic pattern traders often cherry pick examples on charts that show the future. I ask you this, for a harmonic pattern, how do you know that the last price is a swing low? You don't, unless you are cherry picking an example. This isn't a con that's specific to any particular strategy, but you can automatically adopt suspicion about somebody promoting a strategy if they 1, show charts that have future price action displayed during the trade setup, and 2, if they do not show failed trade examples. To illustrate the subjectivity of these patterns, let's pop over to Google. In this example, we can see that the last leg of the pattern is defined from 1.272, while in this one it's from 1.1. Another problem occurs when we're trying to pick which prices to define the price action pattern on. In this instance, do we use the low? Or is it okay to use the closing price? It's up to you. Let's get into the weeds of backtesting. First, we need to develop a workflow for detecting and trading the harmonic patterns. We'll start by processing the prices into local highs and lows, and then we will make a comparison between an observed pattern and the ideal pattern. We'll do this by measuring the ratios, quantifying their closeness from 0 to 1, where 1 is a perfect pattern and 0 is an imperfect pattern. In this case, the blue pattern has a low closeness value, so we will discard it. Additionally, we will avoid the look-ahead bias by always assuming that the most recent price is the D point in the pattern. We can accomplish the first part by using the directional change algorithm detailed here in an excellent video by Neurotrader, which I highly recommend you check out. We can achieve the second part using these custom functions I wrote for the Vectorbt library, which are optimized to be fast enough to detect all of the harmonic patterns over a 20-year period in about 24 milliseconds. What results is an indicator that oscillates between -1 and 1, measuring the closeness to short and long patterns. As the similarity approaches 1, you see that we get an entry and we can take a trade. It also displays the ratios between the legs so that we can verify their accuracy. The way we're going to measure the performance of these patterns is by taking a projection, and the projection will be the relative return after the development of each pattern. So if we look at the price period right after the pattern, we will measure the return from that entry point, and we'll do that for every single pattern that we detect. After we've done this, we'll be able to overlay all of those similarities in one chart. What you're seeing now is the unrealized return after every single long pattern. We're also plotting the 20%, 50%, and 80% quantiles, as well as the mean of these returns in the center of the graph there. Now what we're looking here for is a skewed distribution, meaning that we have a higher density of returns on the long side than we do on the short side. And you can see that we have a little bit of that going on, but it's not significant, especially since the mean and median returns are still hovering around 0. Additionally, if we zoom in on the early part of the patterns, we can see that our returns almost immediately start to go negative right after taking a trade. And I'll remind you that this is a long pattern, and so we should be seeing almost an immediate swing to the upside, and this could indicate that we have a bad entry. Similarly, we can look at the short projections. Now here we're looking for the return to be less than 1 and to be skewed to be less than 1. So we're looking for a higher density on the short side here than on the long side. And again, if we zoom in, we can see that our returns go positive. And if it's a short trade, we're losing money there right at the beginning of the trade. Similarly, the mean and median returns hover right about at 1 through all of these projections. Now we can also look at the returns normalized by the last leg of the pattern. This is something common for harmonic patterns, so we can see common levels for take profit and stop loss. And so if we look at this on the y-axis, we have the percentage level, so 2 being 200% of the last leg of the pattern. So if we were looking for a 30% extension or something like that, we could use this chart to help us set those levels. Now, the expectancy is defined for any trading system as the average win times the win rate minus the loss rate times the average loss. So if we go back to the expectancy chart on the left here, we see that all of the expectancies for both long and short Gartley setups are negative. But you might notice for the short expectancies that it seems to increase after about 4 bars. This would indicate that we're on average entering the trade, at least for short trades, a little too soon, and that if we entered those trades about 4 bars later, we would have a positive expectancy. Similarly, with long trades, we can see that we're entering about 1 bar short and that the expectancy starts to go back towards 0. Now we can manually edit this entry point so that now we see the expected behavior, at least for short patterns, of having a positive expectancy pretty much right off the bat and kind of reaching a maximum about 10 bars in. Now for long patterns, the story is not as good. The expectancy really peaks out about 2 bars after the trade, which isn't the best sign. We can alter our entries on the fly by applying a simple moving average to our pattern similarity line. So the blue line there is a 3-period moving average. You can see that it gets us into the trade a little bit later, which has the right effect. And if we bump that up to 5, we can see that it helps us get into trades quite a bit later, but it comes at the cost of not entering us into the correct trades. You can see here that this is a good trade that wasn't taken, but it saved us from entering on this bad trade. So this is a parameter that we have to be careful with because we want to kind of strike a balance between finding good trades and missing out on the bad ones. Now, I haven't seen enough to be convinced that this strategy holds any weight, but if you've stuck with me this far, I think it's time to look at a full backtest. So for the backtest, we're going to be trading the Gartley, the bat, crab, and butterfly patterns. And since we have several parameters for this strategy to look at, we're going to go ahead and run a backtest that includes all of them. So we have different directional change, accuracy threshold, smoothing, and stop loss and take profit. We're going to do a 2% risk on $10,000 initial balance. We can see that the result of running that backtest over all those combinations of parameters, the best outcome is a 1.75% return. And if we plug those best parameters in, we can get an idea of how the strategy looks. So at first glance, the cumulative returns don't look horrible. We start out negative with about a 10% drawdown. And immediately after that, from 2012 to 2014 or so, we have a 20% drawdown, which no one would tolerate. But then after that, we have a grace period where we have good returns. And you might say, this looks all right, I don't see the problem. But if we turn on fees for all of our trading, which for Forex will just be the spread and the position size, we can see that the strategy really does not perform. Plotted in gray is the effect of holding a portfolio of all these Forex currencies and not trading them at all, and you can see that we just barely beat the benchmark, and we end negative. And so this is not something that a serious trader would trade at all. Now we can look at some of the stats for this trading system. You can see that we have a negative total return, 45% win rate, negative expectancy, but the big thing is we only have 370 trades or so, and this is really low. This is about, less than one trade per pair per year. And so at this point you might say, okay, we're done, we're not going to trade this. But to really hammer the point home, I'm going to run a Monte Carlo permutation test. And this, without getting too into it, is basically a test where we randomly pair our entries and exits with the price and compare our strategy against random mutations of it. And from that we can draw a p-value, which will tell us how close or how confident we can be that our trading system has any signal in it. And we're typically looking for a 0.05 p-value, which would correspond to a 5% chance that our trading system is worthless. So you can see here that none of our p-values are below 0.05, meaning that for most of these strategies there is a high chance that the performance is worthless. But the real burning question you might have is how much you can make trading essential oils. So this website that I found seems pretty great. It's called the Talented Ladies Club. And we can scroll down here and check out some of the statistics on earning with this company. And so you can see that we've got this earnings breakdown, and we can think of each of these percentages as a probability of earning X, and from there we can calculate the expected value. That expected value works out to be about $120 per year, which is $2,280 over the same trading time frame, which is about 20% return, which is not too bad compared to our strategy without trading fees, but is pitiful next to the S&P, which would have returned about 400% over the same time period. Now, typically YouTubers will say, this is not financial advice or anything like that, but in this case, I think I'm advising you not to do something, and I think that's fair game. So, but in all seriousness, I do recommend that this system be tested on multiple time frames. I think there's potential that it could perform better on the lower time frames, and that's a topic for a future video. Really, you should be testing any system yourself anyway and not listen to an engineer on YouTube masquerading as a quantitative trader. If you're interested in learning how to backtest extremely quickly, like I did in this video, go ahead and check out Vectorbt. It's kind of the hot stuff on the streets these days as far as backtesting is concerned. And I'm going to provide all of the code that I used in this YouTube video in the description below, so you can go ahead and go through it and critique it and figure out how I'm wrong if you so desire.